Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for the week end including Sunday, August 4th, 2024. I'm actually doing this on Saturday the 3rd. Hopefully it'll get posted before Sunday morning. I titled the session Overbought Market Sold Off as the Fed Disappoints. Is this the beginning of a bear market? And I'm going to make some arguments during the session of why it might be, but also why maybe we should be looking at potentially to see a bounce early in the week. My name again is Jeffrey Scott, and my email address is hgsidoc@gmail.com. If you're new to the channel, hit the subscribe and the alarm, and you'll get notified when I post these. If you have any questions, comments, you can put them on the remarks section in YouTube or email me at hgsidoc@gmail.com. Disclaimer. This is for educational purposes only. Anything I talk about should be considered in the spirit of education and not investment advice. I am a doctor, not a broker. I am board certified in medicine and oncology, but I'm not certified with any of the series licenses by the SEC that would give me merit to or allow me to tell you what to do. So don't ever assume that this is investment advice. In medicine, it's see one, do one, teach one. I've been trading for over 30 years. I've had great mentors. I've learned to trade. I'm mostly a swing trader to invest to longer term investments. I'm not a day trader. And then in that spirit that doing medicine, I like teaching people how to trade. I don't have a formal education company. I don't charge for education. I do this because I like to teach. I am independent. I don't have any financial ties to any software vendors or trading companies. I use the tools that I have paid for. I do have tool sets in Wealth Charts, TradingView, and TradeStation, and they've been created for me by third parties who offer them for sale. And trading involves risk, and you alone are solely responsible for any investment decisions you make. If you like these videos but you want something shorter, I try when I'm not traveling to post daily at stocksanddocs.com. This is maintained for me by the folks who put on the Wealth 365 event, and it's an opportunity to show you my daily analysis using wealth charts in 10 minutes or less. Major markets tell the story. In yellow, I highlight the major U.S. indices, in orange the equal weight ones to differentiate them from the cap weighted. You could see that over the last 5 days, the only things that were positive were bonds, silver, and gold. That means it was a relatively difficult week. The next one up, which was not positive on the week but was positive until Friday, was the dollar, but the dollar sold off 1% on Friday. So that is not the picture you want to see if you are an equity investor. You could see the broad-based NYSE was down 2.2. The 30 stocks in the Dow was down 2.2. The S&P 500 was down 2.1. The NASDAQs were down 3.1 and 3.4, and the Russell got clobbered, was down 6.8, with much of that occurring on Friday. Now, if you look at performance from the equal weights, the S&P 500 equal weight nominally better than the S&P 500, and the equal weight Qs actually did a little bit, well, a little bit worse than the Qs themselves. If you look at both of these types of indices, or ETFs of indices, you can see that they all hit their lows at the end of October in 23, and each of them are up over 20% in less than a year. So we have had a massive bull market. We've had a market where off the bottom, even what we consider the laggards are now have caught up. Now, what's also interesting is, speaking of catching up, is the Russell 2000 on the year got very close to the NASDAQ, the Qs, but after the week sell-off, you could see the Qs are still up 9.6 and the Russell's up only 4.1. A week ago, they were almost touching. From a sector perspective, and this is looking at the S&P 500 sectors, very defensive. Utilities, real estate, staples at the top of the leaderboard on Friday. And if you broaden out for the 5 days, you can add communications, which and healthcare. But the things that have been leading the market, especially technology, consumer discretionary, all are laggards as the markets have rotated. The Q the Q Edge tool gives me great insight. It's a heads-up display of the market that I look at during the day, because often I'll see the markets doing well at the indice level, but if I see the underlying stocks are not, then that suggests to me that that market's probably not going to stay. When you flip that around and you look at a market that is down, but if you look at it overall on the day and you see a lot of green, again, that tells you that perhaps the market may reverse and head higher. So what do I see on Friday? All the sectors were down. This is now broad. It's S&P 1500, which includes the large cap 500, mid cap 400, small cap 600. So on the broader market, all the sectors were down. The industries, 88% were down, and stocks 84% down. So you got to be a really good stock picker to make money on a day like that. When you look over 2 days, you could see it's just as bad. Over the week, about 80% of sectors, industries, and stocks were down. It was a tough week in the U.S. stock market. This comes in after a period of strength, and if you look at 2 weeks worth, more neutral, and a month still is positive. The other thing it gives me real time during the day is a heads up on my stocks below or above the Bollinger Bands. And I'll go into greater detail on these in a few minutes. But when we start to get 30 or 40% above or below their Bollinger Bands in a broad-based index like the S&P 1500, it almost always signals a reversal. And we're at 16% on the S&P 1500 below their Bollinger Bands. It's starting to get a little bit ripe and might suggest that we've got a reversal coming very soon. If I look at the market breadth tools, the Q market breadth tools, you could see we have a lot of distribution dots showing up. NASDAQ, NYSE, and Russell 2000 all demonstrating them on Friday, and the NASDAQ on Thursday. Typically, that's not a sign of strength in the market. And you can look back, for example, here and see that there are still several more days to go down. So despite the fact that the markets might be getting closer and closer to a bounce point, they still can go lower from here. Up here, you can see a breakdown in breadth. In yellow, stocks above the 50 broke hard, stocks above the 200 broke hard. You can look here, advanced declines turn negative, up-down volume turn negative, and you can see an expansion of the new low percent while we have a reduction in the new high. So a weakening of the market. No new Hindenburg on this, which is a combination of the NYSE and the NASDAQ. If we look at the large indexes, the NASDAQ and the NYSE, you can see both of them gave signs of distribution. Now this little blue line here is a 13-week or 3-month new high, new low. And when it starts to approach this area, I typically see the market rebound. When it approaches the area here, it's overbought. It typically pulls back. So one optimistic sign in the market right now is we are getting closer and closer to that overbought area. And when I look at the major indices, you see the other one with damage, the most damage was the Russell. And you could see after being up in the very overbought range, we've come down considerably across the board. And with things like the Russell 2000 looking like they're getting very close to a place that they will bounce. The Nick Drendel tool's another one of my heads up displays. Why? Because he's taken 25 of the growth type of industry groups. You can watch them intraday. You can see on Friday, staples and healthcare. That's pretty darn well. On 5 days, it was staples and healthcare, which is pretty defensive. Crypto got hammered down 10.2, semis down 9.1. And even on Friday, it was staples, and then that was the only one that was green. It just tells you how broad-based the weakness was this week when you look at that 5 day with only two positive. Up here, it tells me the ending, the change from the open. But what I really like here is this tells me that the Qs, the spiders, and the diamonds actually finished in the middle of the range. IWO as well. ARC not so much. ARC led to the downside. If you look at price compared to moving averages, big deterioration because just a week or two, the majority were above their 50 and their 200. And what you can see right now is pretty much, except for the diamonds, which are still above their 50, we've lost the 8 EMA, the 21 EMA, the 50 smooth, but except for the ARC, they're still above the 200s. This gives me a sense of breadth, and you can see the stocks that have the highest number of stocks in the group percentage-wise above their 5 day moving average is staples, real estate, and utilities. It just tells you how defensive this market has turned. And we haven't gotten horrible on all-time highs and lows, at least in the NYSE, but a week ago there was mostly green there. So we have lost the new highs. So clearly a market that's under pressure here. Now, one thing I noticed is we don't see it all the time to see the rates drop hard in white, whether it's the 10-year on the left, the 30 on the right, and at the same time the S&P falls. So is this telling us something? Is the market concerned that the Fed is going to be too late? Is the market itself going to start lowering the rates in advance of the Fed cutting the short term? Is there a recession in our near future? I think this 10 minus 2 year is going to be the chart of the week from the perspective of recession. And just for those who haven't been here, these are freely available. Sorry about that, on the web. All you do is Fred and then go yield curve or 10 minus 2. The bluish line represents the yield curve 10 minus the 2 year. The inversion is when we drop below the zero line. The gray bars represent recessions. We're going back to the 70s. What you see is when you drop below the zero line, you typically don't get a recession until you get back, excuse me, you get back above. So look at the 10 minus 2. Look at it up close. We are getting close to reverting back to normal on the yield curve. So if you want to say we have a recession coming, there's your data. Nowhere close on the 10 minus 3 month. If you look at a counter argument might be that we're having plenty of economic activity, which you wouldn't expect to have. So right now, I think the risk of recession is higher. I think that the weak economic data on Thursday and Friday spooked the market, which is why we had a sell-off. And now we're going to see, does the Fed come to the rescue? Does just Fed speak come to the rescue? And perhaps we're going to see some of what we saw on Thursday and Friday calm down as participants had a chance to catch their breath. Now, this is a credit risk, and it doesn't look like much, but if I get down to the very tight frames, it does suggest it's moving higher, but it's still in a controlled level. Why is that important? Because you could see the gray bars of recession occur when that spikes. Breath cooled off, stocks above the 200, stocks above the 40 in white dropped. And then here's the 13-week new high, new low or the 3-month as applied by TC2000 on a much broader base of stocks. And you could see we are not at a signal level, but we're more close to a reversal higher than reversal lower. AD lines across the board, the AD lines in yellow fall with price on all the indices, so no new divergences. And then the buckets. The buckets have really flipped. A week ago, we were looking much more bullish. And what we have here is worse than neutral. 59% of the stocks in the S&P 1500 are below their midline. And as I said before, 16% are below the lower band. If you think that the Bollinger Bands are designed to capture 90% of the movement of the stock, and you start to see a lot of stocks going below or above the Bollinger Bands, well, that's not supposed to happen. And it typically will revert to the mean, which means they come up. So when we get to 30%, I'm going to be looking for a reversal. And you could see back on July 16th, we got to 60% above. That was a clear-cut signal. So suggesting we're heading more towards a reversal higher than a reversal or continuation. Still could continue lower. And in times of depression or recession, you can go much lower. For whatever it means, because we're no longer at a top, the Hindenburg-Omen fired twice on the NASDAQ composite. Once on the all NYSE and not on the all NYSE, and once on the NYSE common. So just to remind me and remind you that we're still at risk here. But to me, the Hindi's almost symmetric risk. Yes, at a high, it tells me that the pros are selling to the amateurs, us, and you'll have new highs and new lows on a market that's trending higher. So a lot of entropy. One of the things you see is increasing new lows. And you'll notice on the NASDAQ, we're up to 6.5%. That's a big number. Okay, this entire period up here with multiple Hindenburg omens never went 6.5 new lows. The new highs have come down. You could see on the all NYC 6.5 new highs, only 3% new lows. Both of those are high. And then over on the Hindi commons, 4.6 new highs and over 3% new lows. So there's a lot of exchanging going hands between the pros and the rookies here, the amateurs, and sign of risk, but something that we'll watch. I pay much more attention to it before we roll over. So markets turned down. They broadly sold off. Growth out of favor. Rotation continues. So ERG is EPS rank plus relative strength rank plus group rank. The higher growth stocks will typically be on this group here of ERG. The lower quality stocks will be down here. And what we see here, the zero line is here. So, and we cut out the head because there's like no stocks in the head. We cut out the tail because there's no stocks in the tail. And what we see is everything was below zero. And that when you look here, the worst performance was stocks with good earnings per share, stocks with high relative strength. And that's the comment of growth out of favor and rotation into lower quality RS stocks. News and earnings. So I guess the good news is it's a light news week. We got PMI and ISM on Monday, trades on Tuesday, credit on Wednesday, weekly jobless claims on Thursday, nothing on Friday. We've got one Fed speaker that I've got scheduled. I'm sure there's more out there, but Market Watch showed only Richmond Fed President Tom Barkin on Thursday, a little bit late to talk up the market. You know, Powell was interesting. I listened to his testimony or his Q&A, and he really fought committing to a raise, although he made it pretty likely you'll get a raise in September. And he also really didn't want to commit to 50. The market's now pretty much focusing or voting 76%, I believe it was, likelihood of a 100% likelihood of a cut, 76% likelihood of a 50% cut. Over here on the right, another big week of earnings. Fortunately, the big cap techs are done. It'd be interesting to see what Palantir does. For one that's there, Lilly, what's the competition, which is years away? How does that impact on them? It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. And if you don't think earnings are important, look at Microsoft. Look at some of the other stocks who, you think about it, earnings. There are really two, three, four things that you have to stick the landing with. You have to have your earnings and your revenue for the quarter and the year. Did you beat? Did you raise? The secret one is how did you do versus expectations? And then you have the warnings or other bad news. So earnings are tough. It's not simple. How did my earnings growth do compared to expectations? A lot of things up there. Pay attention. Sometimes pictures tell the story best. I like to go back to this multiple times. Blue lines represent the Fed bottoms, excuse me, the market bottoms. The black line represents the Fed rates. You hardly ever see a blue line before the market rates or the Fed cuts rates. We haven't cut rates yet, so why would we expect a bottom? Over here, just compare two things, the black and the red. And then the third is the black circle. All right, let me get this right. The green square. The green square is the mean bear market, cyclical bear occurring within a secular bull with a mean of a 22.8% loss in 198 days. The black is those that occurred bears in a recession, a 31% loss. We go into a recession, we can get a whole lot worse than we are in what we saw in the pullback to date. Now, sometimes I just want to make a clean chart. I want to identify areas of support and resistance. And I want to see if I can't find on long-term charts support and resistance. So upper left, we see the NYSE composite, 21, 22 highs here. Interestingly, we initially pulled back into that level and bounced, failed at the same level, failed at that level again. Is this a new range for the NYSE? The S&P 1500. Here was the prior high. Here's a pullback into this level here. And it'll be interesting to see if this area here doesn't hold support. Look at the Qs. Clearly you had highs here, some support here, and we've run right into that same area. Would that not be a natural area for support? And if you look at the Russell 3000, here was the highs. Notice this first pullback right into that level. This pullback into the level of the highs here, a little consolidation there. Are we not at least on the 1500, the 3000, and the Qs at very natural areas of support? So if you want to be bullish and you want to be looking at beaten down stocks and thinking about buying them, I think this gives you a little bit of encouragement. Now, to me, the big question is going to be, considering the awful seasonality, which I will show you in the markets right now, or at least for August and September, do we rally up to new highs, or do we rally up for better places to short? And I think the latter is very possible. So, markets log solid declines, some winning sessions in the beginning. We already talked about this. FOMC on Wednesday voted to leave everything where it's at. Press conference pretty much made the market happy, although there was a sell-off on small caps and mid caps into the close. They gave up all their Fed-induced rally from 2 o'clock on. Thursday, Friday, pretty broad-based market sell-off, weaker employment, weaker economic data, and the reversion of the inversion, probably spooking folks. But from a bullish perspective, the markets are sitting on support and potential reversal zones on longer term charts. Falling dollar, falling rates help support the markets. We've already corrected 9% on this little pullback in the NASDAQ. So I expect a bounce to occur this week. Whether this will be meaningful or more likely a dead cat bounce is to be determined. We're entering a weak part of the year from a seasonality perspective, so I expect even a rally will ultimately be sold into. I used the week that was to raise some cash, have less longs, tight stops exist for both my long and shorts, and I'll look for rallies to potentially add on some contra ETFs, because at least in the midterm, short term, I'm more biased to the downside after what I expect to be a brief relief rally. All right, that's it for the PowerPoint. Usually takes 20 minutes. I was a little bit too talkative today. Apologize for that. So here is my unambiguous and specific weekly timing model. And this is what I follow in my trading. Two parts of this model. One is for 3 parts. It's a weekly chart of the major index ETFs. 2, it's a 30-period weighted moving average. And the third is a proprietary, although whenever I do presentations at Wealth 365 or anywhere else, I give out the recipe. But it's a proprietary indicator called the Bongo, which is my trending indicator. Starting in around November 6th, when we turned green on the Bongo and we got above the WMA, we got a buy signal on the S&P 500. And you could see how good of a signal that was. Interestingly, we have not been shaken out of that call in 10 months, 9 months. So to get shaken out, I got to close below the WMA and flip the Bongo. One alone is not enough to stop me out. We are above the WMA, so even though the Bongo has flipped, I give it a yield sign. Still says to be long S&P 500, but not without caution. The Qs have the red Bongo and close well below the WMA. Interestingly, they closed right on their 50. They're into a short mode. However, the Russell and the diamonds have green Bongos and are above the WMA. So I see 2 longs, 1 short, and a yield sign. That tells me caution, caution, caution. Don't go all short yet, but I wouldn't be going all in on the long side. That's all that tells me. When all 4 turn by, I get very long, and you could see pretty much at the same time in 2023, we saw the Bongo turn green, move above. A couple weeks later on the Russell moved above the WMA. Certainly happened at the same time here on the diamonds, on the Qs, and the spiders. So you captured a huge run. Tells me to be cautious. That guides what I do. The daily gives me a little bit more insight, and the daily is in a sell on the spider, a sell on the Qs, a sell. So I need to duplicate. So I've entered a sell here on the diamonds, and at least short term, and that's all this is short term, and now I got to sell on the Russell, correct. So I take my mixed at best on the weekly and my sells on the daily And it tells me be careful, be cautious, and don't go in very much on the long side. And I have a mixed portfolio right now with a few longer term longs still in play, and I've got a couple of shorts entered. And I look to cover both based upon what the market does. I think the market will bounce this week. So that's my timing. So my timing says I shouldn't be showing you anything long because you got to be careful here. I mentioned seasonality, and let's just look at this right now. We'll start here with the Qs. And what this is, let's show you a couple of things. Let me move this up to, we are August 7th here. Okay. All right. So the Qs, even though over 10 years over the next 4 weeks, up 0.9%, so less than 1% move across the board. Look at what the expectation is over the next couple of weeks to peak and roll over. And we've been almost perfectly following this. I expect the Qs to soften here. The spiders. Again, 8 wins over the next out of 10 over the next 4 weeks between the 7th and the 4th. But notice the average return has been negative. All right. And notice it rolls over as well. The small caps. Expect it to roll over. Equal average return minus 0.87. So are we looking for massive moves to the downside? Let's look at the diamonds. No, I don't necessarily think we're looking at massive moves to the downside, but I don't see a market picture that says go out and buy, 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 buy. And you could see a similar pullback expected on the diamonds. And on the diamonds, yes, 8 wins out of the last 10 years, but an average return over the last 10 um, that's been negative. So be careful based upon seasonality. Be careful based upon the timing model. Let's go look at the indices. So the first thing I want to start with here is this is a 5-minute chart of the spider, and I've overlaid on it a number of other indices. The Qs, the diamonds, the mid caps, and the Russell. And what I want to show you is we may have bottomed around 2 o'clock, and you sort of get a sense that going into the close, there was a little bit of move up on each of these. Here is the spider. Let's look at 1, 2, 3, 4, 5 days. So Monday, nothing. Tuesday, a little bit of a sell-off. Wednesday, Fed hope and a gap up into the day, traded higher. This has got to be around 2 o'clock, 2:50. So Powell speaking shook the market up a little bit. The market, after he was done, market sold off a bit. And then interestingly, into Thursday, there was a gap up and then the market was sold, rallied into the close. Friday, gap down and closed much lower. So it was a tough end of the week. No one likes to see this unless you're going skiing. If I look at the daily spider, this was what I thought it would do, and then I didn't know if it would break out, go higher, or break down. Traced back up into resistance and broke down. That is not pretty on the daily. It was down 1.85%. Here is sort of my target zone. So notice it bounced off of it on Friday. That bottoming tail might be a positive sign, something to watch. And let me check on one of my other monitors on the volume. Bear with me a moment. So the volume on the NASDAQ was down 5%. NYSE was up 9%. So mixed volume, not massive volume. Clearly, this is not the final volume for until we get to Monday. It'll probably get set from Friday. But weakness, but right into an area of potential support. What happens if that fails? If that fails, I kind of wonder If this area here becomes at play, and why would I pick this area? Was this area we traded down to in April 24, not that long ago? Um, it will be the 200 will be potentially support first, but this is the area that I'll be looking at. So hopefully we get a bounce from here. No one wants to come down there, and there's probably another area in this range. And perhaps the 200 will get up here when the price does, and that'll be a bounce. So we got resistance above here. We got support below, a bounce off support. Will we trade this week up to resistance? Wouldn't surprise me. And again, I'm not sure it means all-time highs. It might mean think about taking profits on your longs and selling, either buying puts or short selling. Here is the Qs. So the Qs blew through my initial support, blew through the 50, is sitting right here, which is the tops and then the bottoms. Another obvious place for a reversal. I like the bottoming tail, and here was my next target if that does not hold. This is on the daily charts. The Qs on the day were down 2.38%. Again, big moves. I'm not surprised to see some type of a bounce. The diamonds are holding up much better than the others. They bounced off the 50, and they all got this bottoming tail, which again might increase my belief that we're going to bounce up minus 1.49 on the day, and on Friday on the Russell, sitting right on the 50, a natural place to reverse. Topping and bottoming tails, call that a doji, which is an indecision candle. Again, a natural place to expect a reversal, and that was down big, 3.5%. This was a huge move on the week. They dropped over 6%. With the market tough, you know the VIX is going to go up. Let's look at the VIX weekly to get a sense on how much it moved. So the VIX weekly was up 13%, closing just under 900. You could see on Friday, 919. On Friday it was up 13%. You're looking for this type of a bar, a big blow off top on the VIX, which usually signifies a bottom of the market, at least over a period of time. Mentioned dollar weakness. The dollar dropped so hard on Friday, down over 1%, that it took out its 200-day moving average. Weak dollar, you'd expect commodities to be high, but I think there's so many concerns about what's going on in the market here that even gold, even though it gapped higher at the open, couldn't hold it, closed down 0.16. Silver up a little bit. Oil, again, is this economic and slowdown concerns. I've got people worried about Iran attacking Israel this weekend. I have the U.S. sending more military equipment offshore of Israel just in case. Yet oil dropped 3.8%. Somebody's concerned about a recession. And then look at the 10-year. Massive drop, 4.5%. The market's voting. It's voting that there's a recession coming, despite everything else I said. Doesn't mean it's going to happen. Markets could be early. Markets can be wrong. But markets here are concerned. Look at the breadth. What was promising of the strength in the equal weights versus the cap weight on the S&P and on the NASDAQ. Not so much this week. I guess this is something we ought to start looking at. This is the spiders, well, the bonds versus spiders. And why is this something to look at? Because if we got a recession coming, you're going to see the bonds go up. So here was 8, 9, and 10. Here was 2020. Here were some of the shocks. And no, we're not doing anything yet. But you know what? We moved up this week, so it's probably worth keeping eyes on. The other thing is the IEI to HYG. This is showing some credit risk. So The markets are not in good shape. It could change with bounces off support, a lot of volume coming in and excitement, but the market is not in good shape here. The guppy charts is another way I look at the markets. Now, this is perhaps more optimistic because you're getting to a point where on the weekly charts, we are still well above the various moving averages, which is good because when the markets get tough, we'll dive into them. But let me make sure I do this on all the T's. Oh, it's perfect. Let's change that to a daily chart. And you could see we're starting to break into the moving averages. Um, we're at the point where we bounced here. So it'll be interesting to see what happens. There's definite deterioration in the structure of this market. Hourly sectors, what are we looking for? We're looking for, these are ratio charts of spiders versus, or sectors, S&P sectors versus the spiders. If you're up here, that's strength. So healthcare looks great. So let's give it a star. And let's put that star right up here to remind me that it was a strength on the weekend. Utilities, give that man a star. Looks great. Real estate still looks great. Staples, they looks great. Let's give that man a star. There will be a point to my obnoxious comments. Technology, toilet, industrials gave up a little bit. Financials, you lose your star. Energy, weak. Communications, interestingly, is up top. Sort of defying me, but it sold off some at the end of the week. And materials has improved. Look at how weak discretionary is. And biotech weakened some this week. So, what does it tell you when you have stars on staples, real estate, utilities, and healthcare? In a football game, you have one sign that says D, and then they put up a sign of a fence, defense. That is defensive. That is not a good thing to see if you are still long this market in the wrong places. Yes, I think we have a bounce coming. But with everything else I'm seeing, I wonder how big that bounce is going to be, and does it just sucker people in before the next sell-off? Heat map. Let's use it to look at some of the big cap techs. Amazon. Amazon really was looking interesting going into earnings here, and I thought it had hope. It had its earnings come out. It had a 22% beat. And then what it always does is doesn't give great guidance. Amazon opened up Thursday higher, couldn't hold it, and Amazon really had a tough session. Actually, earnings came out, I guess, after hours Thursday, because Amazon just opened up big time on their earnings. Even though opened up much lower, even though they had a big beat, it was a warning going forward. Concerns of the economy, not good. Apple, star of the market, had decent earnings, well received, 4% beat, but it's all talking forward, up 0.68 on a bad session. I mean, I could still be long Apple here. I just worry about the market. Nvidia, a green candle, actually was not up. It was only down 1.7, but it was off its lows. Is it done going down? Well, it's got a little bit of a bottoming candle. I don't know. I like to see it get above the 50 before I got too excited. Tesla, pull back to the 50. If this market shows strength, that might be an interesting place to be looking at. Intel, when I look at Intel, I see a lot of things that you don't want to see. And this used to be a great American name. Look at the fall from Christmas when it closed around 50 bucks to 21 bucks in August. Horrible move. Nothing to like about Intel. Google, it's living in nowhere land. It's between the 50 and the 200. I'm glad it's above the 200. I'd like to see it start to move with some conviction. I'd like to see it get above the 50. Don't like the 17 breaking underneath. Microsoft, interesting buy point, sitting right on the 200. Um, Probably been a long time since you could buy Microsoft off the 200. A really long time. There you go. You could buy Microsoft off the 200 March of 23. Would have been a good buy then. So something, again, any strength in the market, you'd expect Microsoft to be at a really nice bouncy point right here. Meta, holding up pretty well. Earnings were great, if I remember correctly, a 9% beat, just around the 50. AMD, yuck. Now, the thing about AMD and why AMD might be interesting, let's see if I can do this. I'm spending a lot of time on this because you know what? I'm not going to be showing you 100 stocks to go out and buy. Again, I'm not the world's greatest trend line drawer, by the way, so you can take all my trend lines with a big grain of salt. But I would think we're getting near long-term support on AMD. So AMD may actually be telling us it's ready to stop going down. Melly, this is when you have to be careful with the heat maps and wealth charts. They include after hours. But Melly had the after hours on Thursday, so it had earnings on Thursday that were 22% beat, massive, and closed up on the day Friday 10%. Why does it say that it was red? Because it's actually $6 below where it closed in the after-hour session Thursday after earnings came out. Weakness, not a lot of buy me's. If I look at Wealth Scanner, where's the strength in this market? Dividends, utilities, bonds, 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 telecom, real estate, bonds. Here's some materials. Notice only two things above 800. That shows you how much the market has deteriorated. So the CAT scanner is a tool I built that helps me find attractive, let me say that again. Wealth Scanner is a tool that automates a lot of work that I've historically done at looking at charts. Built for me by my friend Rob Hoffman at BecomeBetterTrader.com and the Wealth Charts proprietor, and offered through them for sale. There's a scanner as well for TradeStation and indicators and TradingView. Again, sold through partners. I want to find stocks in an uptrend that have had a recent pullback that have momentum. So this is interesting. I don't have a refresh for Saturday. You're killing me. Let's see. Sometimes I got to do this to get it to reset. So let's see if we can reset the scanner. Go to the stock scanner. Let's go back and look at, just make sure Wealth Scanner comes out the same. It did. Now let's go and look at my CAT scanner and see if it's been updated. Nope. So since it's not updated, maybe it is. How come ACHC is not showing that? Well, let me just see. Was it just ACHC that did an update? Yeah, it looks like some things updated and some things did not. So I'm going to give you a treat. And I'm going to flip out of wealth charts because it's 2 p.m. and they're not updated, at least not uniformly. And I want to show you how I've duplicated the scanner inside um, TradeStation. I still massively advocate wealth charts. I advocate wealth charts because it's an all-in-one program, including data. Rob has just gotten just an amazing deal on real-time futures. If you're non-pro, it's like $6 um, a month, if I remember correctly. He's just passing it through at his cost. The scanners, the free indicators, the educators that he has working for him, um, Ziad, Stacy, Keith, the speakers that come um, on a weekly basis. It's just a great value. But since some people have legacy products, I did this in TradeStation as well. So in TradeStation, TradeStation is an interesting platform if you're not familiar with it. TradeStation has a thing called Scanner. So in Scanner, you can scan a large part of the market as much as you want, but Scanner treats the current bar as open until it closes. So I can't scan on a daily bar with Scanner until after the market closes. And if I run a daily scan during the market, it's going to give me yesterday's close. It has a thing called radar screen, which for many people is worth the price of admission. And radar screen allows you to look at many different instruments and get their values during the day. Now, radar screen will set the bar, current bar is closed. So I'm going to get the daily signal during the day. Now, the problem with that, it's a little problem, I'll be first to admit it, is that things will change. So they don't always persist. But I like to run, one of the things that I do is looking at how do I rank the market, is I can look at force by different time frames. I can look at relative strength change, what's doing the best, and you could see on Friday, volatility, short arc, short the Qs, short the Russell. Uh, I mean, you know, short the S&P 600, bonds, so you could see how weak the market was. But I use this to identify, similar to what I do in wealth charts, what are the leading ETFs. Now, once I figure out, let me stay there for a second, what the leading ETFs are, I can do this. I might ask the question, well, I think home builders is the right thing right now. I'm making that up, by the way. And I could go into data. I got to go add symbol list. And I'm going to go into other symbol list. And I know that ITB, I believe, is home builders. So let's hit ITB and make sure they look like home builders. They do. And I could rank these things by just some of these technical factors of what's working now, what's got the best force, whatever I want to look at. FND, Floor and Decor, I wonder if they had earnings come out, because you'd expect on Friday everything to be negative. So radar screen is cool because it gives me signals during the market hours. Now it turns out people can make indicators for radar screen. And so let me go into this template. And so what I've combined here is a radar screen that includes my buddy Cigar's trading signals, which are here: gaps, breakout, flow, pullback, headwind, box, bounce. And my dots, relative strength to the S&P, relative strength itself, and gaps. And I do that for a reason. And then these are some of the descriptors that you get, jump thrust, extreme, indecision, squeeze move, fan out from Sagar. And these will give you signals during the day. So during the day, I will do things like see who's got the most dots. And I think we all know that Staples did well and Clorox had a great day. Well, I'm not sure I want to buy Clorox, but I found this during the day. Twillo popped up during the day. ACGL turned up during the day. Or I could look at Sagar signals and see which ones have the most bullish signals. IMSI or MMSI, MAMSI, Merit Medical Systems. This is one I liked a lot. So I'm able to do this during the day, and I'm going to show you how I put it all together for an end of day tool. So the radar screen is great during the day. Now, the problem with Scanner is it takes forever, and I have stability issues, and I've got lots of computers, and I like to think it's because TradeStation is still a 32-bit. So I had my friend Van, I think his website's theappstore.com, which I should know that by heart, created a hybrid scanner. Why is it a hybrid scanner? Because it looks like a radar screen. It's an end-of-day tool like Scanner. It treats the current bar as closed. And he was able, for me, with Sagar's permission, to combine my favorite signals, the squeeze, the release, up dots, down dots, EMS, CPR, green candle high, red candle lows, the bongos, the daily relative strength versus the moving average, high-low jump, and relative strength with Sagar signals. And I run it once, and then I do my various scans. So what I wanted to show you was a couple of things. So let's look at, and I run this on my consolidate buy list, which is a pretty big list. So let's look at some of the top performers from, this is going to not be optimal because it's going to, let me do this. Some of the top performers using my tools, which are the same tools in wealth charts. So Clorox I already showed you, and I looked at it. These are some auto-generated resistance lines. This red one is the 200. The yellow is the 50. If you see a green, which is here, is going to be the 17, I believe. Here are my dots, similar to what you see in wealth charts. Here's my high jump. Here's the OBV, and for whatever reason, it didn't give me the relative strength. I guess I got some settings set up. Mealy, what a great move here. All right, so I think, let me see what I want to do here. Let me pull this thing out. Let me go to here. Let me copy this window. Let me go back here, paste window. Now, by the way, not getting updated on wealth charts is a rarity. If I was giving a program on wealth charts, all I would do is I would have checked that earlier today, and I would have texted Rob, and he would have made sure the update went through. So here, let's go back to Clorox. I got to change this to light blue. Sorry about that. Perfect. I guess that's called cyan. So Clorox, I don't like all these resistance lines above. MELI, you can see the dots down here. You can see the relative strength. You can see the OBV. Again, exactly the same thing I'm doing on wealth charts. Same dots, although I do the gap dot is yellow. And you could, and then the EMS signal is built into the dots here. Blue is a buy, Y is a short. I don't like the resistance above. Vanguard SH, short-term, short treasuries, so bond, so rates. Again, not something I typically buy. Ferrari's been a big story, race. Now, it might be ready to break out, but look at this, it's running right into resistance. So I probably would not buy it here. I'd wait till it broke above. Twillo. This one, this is like a fallen angel to me. This once was a great stock. Great, I don't know, I can't say about the company, I have no idea what they even do. But this is a stock that's a falling angel, but notice how it broke above the trend line. It had a wealth signal, it had a gap up, volume, breakout momentum, PSAR flipped, it's not extended, relative strength looks great there. and OBV looks great. The Bongo just flipped on the daily. I like Twillo, and Twillo will be on my buy watch list. Although, to be very, very clear, not buying a lot of stuff at the open on Monday. Got to see what the market does. Demata Therapeutics, yeah, it's in a short-term uptrend, I guess, for 3 days, and the Bongo has flipped, I guess, off of this bottom. The weekly is flipped. This is just a beaten down. I wouldn't look at this. Budweiser, another consumer staple. I guess we drink beer during recessions. Breakout, momentum, volume, gap, excuse me, gap and EMS, not the volume. Relative strength looks great. I have to figure out where OBV went. All right, here's OBV. I have to bring it up. I got some setting stuff to fix on this. There you go. OBV looks good as well. Bright Horizons, BFAM. I believe this is is it an education company or is it? But what a nice, here's long-term resistance, a fresh breakout off of trendline support, gap, volume, breakout, momentum, relative strength looks great. I'm not going to start playing and trying to find all the OBVs. It's there somewhere. Weekly chart looks good. I like this one, BFAM. And I can go through the list and look at some of those that are leaders. And here, for those of you that own Sagar's Q Tools, is where the magic comes. I am going to take filter results, and I am going to open my favorite scan. And my favorite scan is pullbacks and uptrends with a Q breakout. And I'm going to hit OK, and that list is going to get small. And these are where I'm going to concentrate on the market. I'm going to have Van make it so I could cut these. So what I'm going to do is I'm going to write these down very quickly, and then we're going to go into wealth charts and take a look at them. So what this tool is allowing me to do is it's allowing me to scan the various Q signals and my signals, get the stocks that meet my criteria, and over the last several months since Van built this tool and made it available to me and the people that own Q at the Q tools from Cigar and my stuff in TradeStation, it's been my real go-to. I'm going to look at the top 6. All right, so let's go back into wealth charts because I think the charting platform will be easy for you to see. First one to look at is Clorox. I already said that I didn't love it, and let's just take a look at it. And the reason why I didn't love it was because of trendline resistance. And why does it have trendline resistance? Well, here's a stock that is way off of its highs. Now here it doesn't look that bad, frankly. You've got earnings that you had a 15% beat. Staples are leading. Here's the wealth signal firing, not extended, relative strength and OBV. So not my favorite kind of stock, but that's Clorox. MELI, Mercado Libre. You could argue, that maybe the trend lines that matter is that, and that we got a fresh breakout. And I think you probably do. Again, tough market to be going massively long. But MELI looks really good. You could see breakout momentum. Here's a flip bongo, not extended, relative strength, looks great. OBV is coming along. Twillo, I mentioned that I like this one. Again, I'm not talking fundamentally, I'm just talking about charts. Like the last one, I've got to be concerned about overhead supply and resistance. So that is a potential negative. And I think they must have used this trend line because you could see with this trend line that we have broken above the trend line. We broke above the 200. You can see earnings are out with a 24% beat. I just love this feature in wealth charts that it tells me what the earnings were and expectations. Coming out of the squeeze, not extended relative strength OBV look good. BFAM, which we looked at in the trade station, but these are the same signals. These are the signals that came up to the top. And there's a big breakout. Is it too extended? Yeah, it's probably too extended. But notice it's got a launch indicator and a wealth signal. Here's my EMS a couple days before. A breakout in momentum, relative strength, great, OBV plus minus. Um, Probably put it on a watch list if there's a pullback, but that's a lot of strength. It must be earnings related, 20% beat. And that's something to be aware of. A lot of the things that are showing strength had good earnings. RARE gives us a healthcare stock. This is a rare drug manufacturer. And, it's kind of loosey-goosey. But if we do a trend line, let's connect this through here. You got a fresh breakout. Now, am I surprised I'm seeing trend line breakouts on every one of these? No, that's what the scan was to find. You got a well signal and a launch. You got a breakout in momentum. You're not extended. Relative strength looks great. OBV is okay. I like RARE. And then lastly, GDDY. Wow, this thing has just gone crazy. Um, and I use them. I'm sure a lot of people use them for websites and things. Interestingly, they missed their earnings. Now, how is it possible that they missed their earnings in a horrible tape and it's a weak market? Because they may have missed their earnings, but they grew from 54 cents to a dollar one, so they're only almost doubled their growth. Their whisper number may have expected it to be worse because of the slowing down economy, and they may have raised, which I don't have here. So lots of things impact. It's not just the earnings. But what a beautiful chart. Um, it went sideways enough here that I'm not adverse to this stock. It's not extended by high jump. Relative strength looks great. OBV is fine. But that's GoDaddy. So I think the overall message I want to leave you with is one, I'm sorry it took me over an hour. I got thrown when my scanner had an updated wealth chart. So blame it on that. Number two, be very careful this week. I don't think this is an easy market. I don't think you could be all into either side because even though it felt Thursday and Friday that we're in a bear market and we're going to go much lower, we're at long-term support and a bounce here would be nothing surprising. But I'm going to go back to my wealth charts and let's go look at the indexes and look at the dailies. On the spiders, we are below 50 and we're below what was support, which will be resistance. We got a lot of things to get through to set all-time highs. On the Qs, we're below the 50 and two areas in addition that will be resistance on the way up. The diamonds, not really. Diamonds got some overhead supply, but they're not sitting below massive resistance. The Russell dropped below this congestion area, but still better shape than the other two when you look at resistance. So when I think about that, I think about my market timing saying be careful. My guess is we get a rally this week, maybe not Monday, maybe not Tuesday, but we run right up into that resistance area. And then maybe next weekend we can talk about how we had a decent week. But now we got the question is, do we fail or do we break through and go on to new highs? Remember those seasonality charts? I'm going to bet that we rally up, we fail, and we go lower before we make new highs. Have an awesome week. Again, apologize for the length, apologize for the switching of platforms, and we'll see you next week.